We don't really know where the world is gonna go. But now everybody knows that you can't stop for too long. Got to keep. But now everybody knows. Got to keep.
You don't have to be retired to receive tax-free income. The problem is the vehicles that we've been conditioned to believe to help get us there were never designed to produce income.
Got to keep going. What you want to be going, you will see. It's your destiny, be in harmony. We were never meant to be apart. What you want to be going, you will see. You can have everything you want. It's your destiny, be in harmony. Ooh.
If you had a machine in your garage and all you had to do was put a quarter in it and it printed out $100. Put a quarter in it, printed out $100. Would you ever stop that machine from running?
But now everybody knows.
So what if you use that job that you hate as leverage to fill your machine so they can create income for you, so you don't have to worry about income?
We know where the world is gonna go. But now everybody knows that you can't stop for too long. Got to keep going.
Welcome back. We are going to continue this conversation. Hope everybody's doing good. Hope you had a chance to watch our last live stream so that you know what the heck we're talking about. Right, Donnell?
Yeah, I mean,
Yeah.
because, you see velocity banking and you assume one thing, right? We're going to get rid of some debt, free up some cash flow. Actually, we're going to do things a little bit differently today. So,
Yeah. We're going to debunk some myths. We're going to spill some tea. We're going to peel back some layers. We're going to show you some of the math behind why this works. So that's one. And there's been some questions that came up since we've been talking about this. Some people said, like, what the heck is this? And how does it work? People say, is this a scam? Never heard of this before. Well, doesn't mean that it doesn't work, first and foremost, right? Everybody's heard of being broke, but nobody wants to do that. So we have to find new solutions, and we found them. And while there are many ways to 10, we say that all the time. How you get there could be different for everybody and could look different for everybody, how you build your machine. And so that is what we're going to kind of dig into today. If you have a question, if something came up for you when you were watching the last live stream, please put it in the chat so that we can address it. We really love to know, like, what are your thoughts as you're watching this information? Is it confusing? Even if it's just your thoughts around how this information is sitting with you. Is it difficult to understand? Is this something where you're going, I don't know if this applies to me? Or are you going, I can't wait till you guys move on to other strategies, because those I feel like I can dig my teeth into, those I can take action with, and this, not a vibe. We would love to hear from you, because the whole point, we're here for you. We're here for all of you. So that's really what it is. Anything else you want to address before we jump in?
So we are going to kind of rehash or go back through last week's example. Last week? What's today? Wednesday? Sunday? So yeah, anyway, the example from a few days ago, and I'm not going to spend a whole lot of time there, but I do want to just go back and just remind folks of where we landed. And again, today is about reverse velocity banking, but it's kind of answering some of the questions that I received throughout the week and that I've received in the past as it relates to reverse velocity banking. In full transparency, I don't know that you will find anything related to reverse velocity banking from anywhere other than this channel.
Yeah.
Because we coined it. And the thought process is this. It applies. If it didn't apply, we wouldn't use it. And the thing is, I think people are starting to fully understand how velocity banking works. And the idea here is, what if you could do the same thing, but use other people's money doing it? Use tax-free dollars doing it. Put yourself in a position to where you could replace your income. And so that's kind of what we're talking about today. So I like how you put it. Debunk some myths, answer some questions, kind of show some a little bit more detail around, hey, is this a scam? Is this even possible? Stuff like that. So.
Well, there's a lot of myths I feel like we could debunk. And I think it's how we look at opportunities and how open we are or closed we are to being able to receive information too. Some of the questions or some of the temperaments, I would say, around this information, some of them come from very traditional ways of thinking of things. However, I think our results and what we're seeing in our accounts and in our level of financial security, that would show people that traditional doesn't work anymore. Like, we need to make traditional being financially secure not how you're getting there, so that we can open up the doors to new opportunities as they come along, because the world evolves. So there's a lot that we have to unpack. So let's jump in. I'm just wanting to share all my feelings right now about what this rant I'm holding in. Okay, but I won't. We'll get
Go jump in
into
the
it.
chat. You know, you really just want to go jump in the chat.
Yeah, well, that too. Yeah. Okay. All right. Well, hold on
Yeah,
one
let's jump in.
second. Yeah, let me make sure let me make sure we're ready to go before we go. All right, here we go.
So again, today is about reverse velocity banking, and the thought process is kind of talk through some of the example that we used on Sunday, and just kind of make sure we set the stage and make sure everyone's on the same page. But before we jump into reverse velocity banking, as I like to do, we have to explain, well, what is velocity banking? So before we reverse it, let's kind of talk through what velocity banking specifically is, and I'll leave this up. If I got that. So the thought process is this: you have a certain amount of income. And in this case, I was showing, this is just an example. I was showing about $50,000 going in as income. Traditionally, that income, and I'll make this bigger because it looks like it's pretty small. Make it bigger. This $50,000 going in as income traditionally goes into a checking account. And then we traditionally pay our normal bills from a checking account. But with velocity banking, the thought process is to take all of your income and move it to a debt tool, some type of line of credit. Credit card, line of credit, personal line of credit, HELOC, home equity line of credit, BLOC, business line of credit, doesn't really matter. Well, I'll take that back. It matters, but in most cases, it's some line of credit that's open-ended that allows you to be able to put money in and get money off. And then when you do that, you then pay bills from that line of credit. And when you do that, and in this case, I was showing $50,000 coming into the debt tool, bills being $45,000, which means what's left over is $5,000. Well, what happens with that $5,000 in cash flow? What happens is that $5,000 in cash flow lives on the debt tool. I think the piece that a lot of people get confused about as it relates to velocity banking is, I think people tend to make it, or I guess another way of putting it is, people tend to overcomplicate velocity banking. And because in truth, velocity banking is just about the debt tool, meaning this cash flow living on this line of credit does what? If it's $5,000 a month of cash flow sitting on that line of credit, as opposed to sitting in your checking account, what happens is that $5,000, which becomes 10 in year two, 10 in month two, which becomes 15 in month three, and so on and so on, that $5,000 of cash flow living on the line of credit starts to reduce the balance of the line of credit. Well, when the balance on the line of credit reduces to a point where you have room and availability to do other things, the question then becomes, what do you do with this cash flow once you have it? And so in the thought process from a velocity banking perspective is, then you take this cash flow and you get it to work. Meaning, after all the bills are paid, after I've paid my mortgage, after I've had my fun, what's left over, I get compounding. I get it compounding in the wealth equation so that I can start generating pure, uninterrupted compound interest. Well, the thought process behind reverse velocity banking is this: what if we could do things a little bit differently? What if that full amount of your income, and in this case, $50,000, could immediately go on to a wealth generating tool? Well, what do I mean? Wealth generating tool, unlike a line of credit, is a vehicle that is secure, produces uninterrupted compound interest, and allows you to be able to leverage or use those dollars at any point. So I'm not talking about waiting till 65 once you hit retirement age. It's putting your money in a vehicle that, regardless of age, as long as you have enough cash value in it, you can use the dollars in it to then pay your bills. So you borrow against the cash value in this wealth tool, in this secure compound interest account, use that leveraged dollar to then pay your bills. So you pay your bills with the leveraged dollars. Now, what's unique about this I'll call it process, is one, It doesn't happen tomorrow. It's not fast. It takes time. But once you build up enough time, you also build up enough cash value inside the product that will produce income for you for life. So this is not for everyone, but if done successfully, if committed and done successfully, it can actually be a pretty powerful tool. And so what we did on Wednesday was we walked through a little example, and this is we reintroduced this couple because this couple, we had done an example in them a while back. This is Jerry and Jess, and there was one path that I kind of highlighted to go down, but they came back to me and said, Donnell, we saw one of your reverse velocity banking videos, and we actually think there's a better way. And so they kind of remixed my thoughts and said, hey, we want to kind of focus our attention on becoming structured such that we can do reverse velocity banking. And the thought process was this: want to put all of her income to work, live off his, and eventually in a 10-year span, have enough income generated to be able to fire their jobs if they wanted to. So what did that look like? It looked a little bit like this. See if I can get a little bit smaller. It looked a little bit like this. Jerry making 83,000, Jess making 65. They have in total $148,000 a year in income. And I get it. That's a significant amount of income for these individuals. Jerry is 32 and Jess is 28, I believe. That's a significant amount of income. But what happened was they moved from, I'll call it a high cost of living state to somewhat of a lower cost of living state. And what they determined was, you know what? They are just fine living off of Jerry's income. So all of Jerry's income went towards expenses, which means it left Jess's income available to get compounding. And that's exactly what they did. And in the process of doing so, let's see here. And in the process of doing so, that $65,000 over a 10-year span was able to produce cash value of about $910,000. And that $910,000 equated to about $83,000 in income, which means if you're able to get $83,000 a year in income out of this secure compound interest account, oh, and by the way, the income generated inside of this secure compound interest account is tax-free. So if you're able to use tax-free dollars to pay your normal expenses, what that does is it leaves Jerry's income available to go get compounding, to do other things. Maybe they want to buy property. Maybe they want to buy land. They don't necessarily have to put it in a secure compound interest account. That was just kind of my thought. But the bottom line is it frees up Jerry's income to go do whatever you want. And notice, it didn't happen in year one. It didn't happen in year 5. Now, there's some action that could have been taken in year 5, but I didn't even mess with that. I went immediately to year 10. Year 10 means that Jess is now 38 and Jerry is now 42. So they're still fairly young, still in a position to be able to fire their job if they want, still in a position to be able to retire early, but it allows them to comfortably be able to pay their expenses. And one other thing I know I didn't kind of highlight was I'm assuming in 10 years their expenses didn't change. And I know the fact is, or the truth is, in 10 years, their expenses may have increased. But in addition to that, Jerry's role or his position at his job and Jess's position at her job would have also improved, which means their cost of living may have changed, but also their income would have changed too. So what I'm doing is I'm keeping everything, I'll call it on a level playing field, not accounting for any of those additional dollar amounts. We can, but I didn't in this case. And after going through that example, I got a fair amount of feedback. And it came in different places. Some of it was in the chat. Some of it was attached to the chat of the video. And it was questions like, hey, how is this possible? Like, there's no way. There's no way you can do this. This must be a scam. I would have heard about this if this is something that is even possible. But then I would also start to get questions of how is it possible? Like, what are the steps I need to take to be able to do something like this? Like, this sounds amazing, but what does that mean? And these are some of the additional questions that I received related to how long does it take? Because you said that, this isn't something that happens overnight. So how long does it take? Or better yet, is it too late for me? Based off my age, based off my income, is this something that is even an option for me? And one of the questions that I loved, and I'm going to address that now, is this one. I have a cash value life insurance policy. I have a whole life policy. I'm using my policy for infinite banking right now. Can I use my current IUL or my current whole life policy to be able to do a process like this? And we're going to dig into some of the details later on as I kind of move through these slides. But I want to provide this answer now. And that is, as it relates to, can your cash value life insurance policy, like a whole life policy or like an IUL, do reverse velocity banking? It all hinges upon one factor. And that factor is this.
Oh, let me move you so we can see what you're writing. That's
I'm moving.
funny.
I'm going to move it over.
No, I got it. I got it.
So the question is interest versus interest. So the question that you have to answer is the interest earned more or less than the cost, the interest that it cost you inside of your policy? So what do I mean? What I mean is, if you have a whole life policy and you're getting a guaranteed 4%, like that's awesome, right? Guaranteed, consistent, uninterrupted compound interest of 4% inside of your whole life policy. But what does it cost you to be able to leverage your money inside the policy? Again, interest versus interest. The interest you're generating or earning over time compared to the cost of the dollar amount that you're trying to use, and that interest. Interest versus interest. So if you're making 4% guarantee, but it costs you 5% to leverage your money, that's a negative arbitrage, which means you're actually losing money inside your policy. If the growth inside your policy isn't positive, then 9 times out of 10, this is not an option for you. So I just want to make that clear. And we'll dig into some of those details and I'll show you what that looks like mathematically. But I just wanted to kind of address that early on. And that is, can you do this inside of some different cash value life insurance policy? It is purely based off interest versus interest. If you have a positive arbitrage situation, then absolutely you can. And so where does it start? As it relates to doing reverse velocity banking, it all starts where all of my conversations start. It starts with the goal. What is the objective? Why are we doing this? Meaning, whether or not reverse velocity banking is something that might work for you depends on what your true goal is. If your goal is to pay off your home, if your goal is to become debt free, if your goal is to pay off your student loans, if your goal is to do anything other than get money compounding and create as much income as possible, as quickly as possible, 9 times out of 10, this may not work for you because your goal is not aligned with how reverse velocity banking works. And what we'll find is the way reverse velocity banking is truly effective is solely based off whether or not you get started or how quickly you get started, how quickly your money is compounding. Let's see here. And as it relates to the goal, you've seen this many times. We've covered this a lot. And that is, as you're identifying what that goal is, it really starts with, what are your numbers? We offer many tools for you to be able to kind of break down and understand what your numbers are, understand how much cash flow you actually have, and in addition, what you need to contribute in order to be able to hit whatever your goal is, if it's a number, if it's a date, and how to account for inflation. And I think this is a piece that we don't talk about enough, but I think we can all agree this is the reason why people end up going back to work once they retire, because they're in the position to where they end up running out of money. And so therefore they need to compensate. If they were putting their money in a position where it could compensate for this inflation rate in the beginning, meaning if I was already shooting for a goal that already included what the cost would be in the future, then less people would end up having to backtrack and end up going back to work. So the idea behind this is, as you're identifying the goal, is making sure you understand what your numbers are. And as it relates to velocity banking in general, velocity banking doesn't necessarily mean movement. And I get it. Velocity of money, movement of money. The other piece that is impactful as it relates to velocity banking and the velocity of your money in this case is time, the factor of time. Meaning you've identified your goal, and your goal is to put your money in a position so that it's compounding as quickly as possible. Okay, awesome. But what's your time horizon? How much time are you going to allow your money to be able to compound? And if you're going to put your money to work and you're going to allow that time for your money to compound, how long will it take for you to be able to accomplish the goal that you're looking for? So the time horizon, the time factor is a very significant piece here. And what I mean by that is it's about compound cycles. Let's see here. Meaning, based off your age and based off your desired, okay, the moment in which you desire to be able to achieve or receive income, that will determine whether or not your money is, one, compounding enough for you to be able to take the income that you want, or do you need to adjust what it is you're contributing to be able to hit that goal? So understanding what your true compound cycle is, understanding how much time it's going to take for your money to double. That when I say compound cycles, what I mean is the amount of time it takes for your money to double just one time. So understanding, one, how much you're contributing, what's the impact of what it is you're contributing, and your time horizon, how much time you're going to allow your money to compound so that you can start receiving it and using it as income, again, is a huge factor in this case. And what it all boils down to is this. And this is something that, again, if you've been on this channel anytime, any amount of time with us, you know everything evolves around the wealth equation. So it's, as it relates to paying yourself first, meaning getting that dollar amount compounding as quickly and as immediate as possible. So using the wealth equation, that A stands for pay yourself first. But when should you pay yourself first? Again, if we're talking about reverse velocity banking and having a dollar amount that we're able to leverage and use as income as quickly as possible, you can't wait until you pay off your home to get this process started. You can't wait until you've paid off all of your student loans to get this process started. The question is, if this is a goal of yours, then are you getting your money compounding as quickly as possible? So it's pay yourself first. And when should you pay yourself first? Immediately, today. So these two variables are critical as it relates to whether or not determining whether or not reverse velocity banking is an option for you. So pay yourself first, immediately, starting today, and then that security piece. And I think that's kind of where we're digging in. Okay, so as it relates to the next stage as to what or how or whether or not velocity banking might be right for you, is understanding your perspective on money. And this isn't, it's pretty obvious, right? How do most of us view money? We view it as currency. We view it as an exchange of goods and services, right? But what if we were to take a different perspective with how we view money and look at it from the perspective of how do you get your money working for you as quickly as possible? How do you turn your money into employees? And think about it. If you're effective in hiring your employees to go to work for you, create and generate compound interest for you, what ends up happening is your money makes money, and the money that your money makes more money. Meaning, those employees that you just hired to do a job are now recruiting others to do that job for you. And so what ends up happening is your corporation, your money making money, and the money that your money makes tend to make more money. And here's the beauty of putting your money to work. Putting your money to work in a secure compound interest account, putting your money to work in a vehicle that is secure. The cool part about that is these employees require no days off.
Right, that part.
No vacation, no holidays, no sick
benefits.
days. They work 24/7. They work while you sleep. So the key is, can you put your money in a position to where whether you're up or not, whether you're working or not, whether you're at your W-2 job or not, that money is continuing to make money for you, and it's continuing to recruit others. So I get it. Most of us look at our money like this, a medium of exchange, currency. But what if we could just view this a little bit differently and put that money to being very intentional about our W-2 job? Take that check that you're getting from that W-2 job. Don't just spend and increase your lifestyle. Understand that W-2 income that you have has power. And if you do it right, if you use that W-2 income properly, you can actually put it to work. So in the vein of pay yourself first, meaning I'm going to skim off the top, take a portion of my W-2 income and put it in another vehicle. Did you have a question, sweetheart?
No, this is what I've been holding in, because this is what I really wanted to peel back last on Sunday when we were talking about this. Because the concept of using your cash flow on your debt tool is to reduce the interest that you would pay and reduce your debt, right? Knock that debt out. essentially what you're doing is instead of it sitting in your checking account or your savings account, that extra money after you've paid bills, right? Especially the minimums on bills or whatever it is you're paying, whatever's left over your cash flow. That's what's actually working for you. So if you think of this in the same way, it's easy to understand with velocity banking. This is why a lot of people jump on it, because it's easy to get. Okay, if I just let it sit there, I could access it at any time. At any time I can access it, but while it's sitting there, it's actually doing a job versus not helping me, right? Okay, so in this particular case, when we go, here's what I wanted to peel back. Same thing for wealth building. It is sitting and it is working double time for you. Those are just words, but hear me out. The reason why we're using the concept of employees is not just because it's simple to think about, right? You hire employees and they do the work for you. That way you can get more work done that you can't do. You can't multiply yourself or clone yourself. So it's the next best thing to cloning and scaling time, right? And efforts. When we think about what are we going to do when we retire, or when we no longer can function or want to function in our careers as they are right now. Most people have the idea that they want to have a encore career. Like, I wish I could see a raise of hands of people who have thought about starting their own business as a second form of income, or thought about what would I do if I quit my job to retire and I needed some extra income. This business or this venture is what I would do in order to generate extra income or help me to safeguard against inflation. Probably the majority of people have had those types of thoughts. And it's not that people don't need extra money. That's not the point. The point is that you have the opportunity to start earning that extra money without having to start a business. That's the important part. Without having to take the risk, without having to trade your time, the time that you're already spending. You don't have any more time. So we're going to employ our dollars to be working for us in the meantime. Does that make sense? It's like an army, and they're just sitting there. The majority of people, it's just sitting there in an account. It's sitting there in a house. It's for most people, it's sitting in a house, just sitting there, collecting dust, literally. While the bank is using it, the bank has employed your dollars. Your money is now working for the bank, because best believe they're using it, right? But we're not taught how to do that. And so what this does is it flips that around. So now imagine this. If the concept of starting your own business was ever attractive to you, and you're thinking to yourself, like, I have an entrepreneurial spirit, I can do this, I want to be able to do this, or it's more of the time freedom or the maybe the limitless type of feeling that you get when you think, nobody can decide how much money I can make. I can make all of this money if I worked for myself. But without a business model, without systems, without all of these other things, right? Is it truly possible? The majority of people go out there and they start a business because they need to profit. They need income, realizing that they can't profit until they've paid all of these things. And it wasn't what they thought it was going to be in the first place. How many years do you go down this road because you're already waist deep and invested in this business? You're still not profiting. It's heartbreaking to see people in this situation. And as a marketer, I've met many of them. And it's not because they wanted to start this business. Some of them started the business out of a need. Some of it, at the time, there was a need, and now they're struggling because maybe the trend has moved on. Maybe cost margins have changed or shifted over the years, and so their products are more expensive, and so therefore, their profits are down, and it's not an equation that they wanted to ever have to face, simply because they really didn't want to have a business. They wanted to have time freedom, and they wanted to have the income. We can appreciate thinking of this scenario. We can appreciate if we thought of the ability to plug into a system or start a business. Let's keep the theme. Start a business where all the systems are set up for us, right? You've got, like I was telling Donnell earlier when we were kind of walking through this example, if we were going to start a business and a YouTube channel and all of the other things that we had, if I had to code a website and I had to code emails and I had to code all of these things in order to be able to digitally send them out and share them with people, we would not be here. We're only able to do all of these things because we can leverage systems and machines that already exist, and we're just plugging them, we're just connecting them together, right? That's essentially what we're showing you how to do with this. There are already machines and systems that are already built, and you don't have to build them. You don't have to make them work. They just work on their own. It's leverage. Leverage is the most valuable piece of this machine, making sure that you have leverage, and it's not just in one place. So in terms of the machine, the part is, and this is why we shouldn't talk about stuff before we could get on here, because now I'm like, I already said all this stuff to you. Now it just sounds lame coming out second time. Okay, hang in here with me, guys. I'm almost done. The point is that if you think of it like a machine, and we're building a machine, many ways to 10, we have 5 different strategies in our personal machine, right? So if this is one of the cogs in your machine, but this runs on its own and all you have to do is feed it, okay? Versus you are the cog in the machine. And the saying that I love is, if you're the cog in the machine, you become the clog in the machine. Where do you have access to a machine or a system that will continue to go, continue to move, continue to work and function without you? You step away and it thrives completely on its own. That's a system, that's a machine, right? So that's what we're trying to get to, because at some point we cannot come down to us if we make a decision wrong, if we have no control and we can't move when we need to move or take advantage of opportunities as they come. So I'll leave it there. But the point of the reverse velocity banking and why we are using this particular term, there's another term for what it is that we're talking about. But why we're using this particular term is because you can understand how cash flow sitting on a tool where it would be just sitting anywhere else collecting dust. Now you can see where sitting on the tool is actually more beneficial and helps because you have put it to work. So that's the point, without having to do anything extra, right?
Absolutely. And you know what you're also speaking to is the difference between, because if you look at the cash flow quadrant, right? If you look at the self-employed compared to the business owner, most people think it's business owner, but it's business owner of business systems. So the self-employed, all they're doing is buying a job, right?
Right. Yep. Yeah.
But the business owner, they own systems, and it's those systems that run, whether they're on the beach,
Right.
in the office, or at home, it doesn't matter. The systems continue to run. And that's really what we're looking at here is building a system such that whether you are in the middle of it or not, it continues to run. And it's okay if it's not running as efficient, right? Because we have to learn, we have to get to a point where it's running efficiently. But it's okay if, you know what, this system doesn't require me 24/7. But it is a system that at least I'm adding the right pieces to so that it can be self-sustaining.
Yep, that's
And
it.
so,
I know we've got some questions, so go ahead and let me know when you're ready.
okay,
Okay.
it's because we're almost done anyway. So, and again, so as it relates to taking a perspective of having the dollars that you make, the income that you make, the money that you have, start treating them as employees. And the objective is to put them to work. But what do those employees need? Meaning, to be successful, what do your employees need from you? And think about yourself in the job that you're in. Don't we need security? Like, if we're working in a space, isn't the security knowing that, you know what, when I my 40-hour week pay is going to be consistent, I've got health care, whatever those pieces, those reasons are, you work for the company that you work for, it's about security. But security doesn't necessarily mean, because a lot of times we confuse security with, hey, I want to pay off my home. I want to pay off my student loans. I want to become debt free. It's not necessarily debt free. It is literally security. So where does that security come from? How do you put your money in a position such that it is secure? What does that look like? Well, again, it goes back to the wealth equation. It is about paying yourself first, starting today, but where? Where do you put your money? You put your money in a position to where it can work for you, and it only works for you if we can reduce or eliminate risk. The difference between this equation and the investment equation, and a gentleman there was a comment left on one of the videos related to this as well, meaning investment doesn't necessarily involve risk. Okay, the investment equation in most cases involves risk. In most,
Where are you investing where there's not a risk?
that's my point. And so what I was trying to help the gentleman understand is the objective is to reduce the risk.
I wonder what he meant.
Well, and I think what he was saying was if you're smart enough, you can avoid risk. But what he's talking about is timing the market. You can't time the market.
Okay.
But bottom line is the more you can reduce or eliminate that risk, the better it is for you to be able to achieve compound interest. And again, you get your money compounding in that vehicle, your money making money, and the money that your money makes more money, or your employees go to work. And as your employees go to work, they recruit more employees to come work for you, work with you. And then if you put your money in a position to where it can leverage OPM, leverage other people's money to help grow your money faster, create an opportunity where there's an arbitrage situation. So what does your money need from you? It needs this. It needs the ability for you to start today, paying yourself first and making sure your money is secure. You put your money in a position to be able to do that. It doesn't have a choice but to continue to generate income or wealth for you. But let's speak specifically as it relates to you. What's required of you in this process? And this goes back to, hey, am I too old? Is it too late? Will this work for me? And this is a standard response that I talk through when we are talking about creating secure compound interest accounts or self-directed retirement accounts like a self-directed 401k or IRA. It takes commitment. But specifically in a SKIA, you also have to be healthy. Again, commitment, healthy, and you can have the right vehicle, you can have the right knowledge, but it all starts with the right you. But ultimately, what I'm saying here is, from a commitment perspective, we have to learn, relearn, sometimes unlearn that it's not as simple as Bitcoin, meaning you're not going to be a millionaire tomorrow. It's about getting rich slow. It's about slow, steady, and secure growth. And as it relates to health, it doesn't mean that you have to be a picture of health. What it means is you do have to qualify. If you're wanting a product that's going to build compound interest for you over time with leverage and using all of the variables in that wealth equation, you do have to qualify for it. It is just not going to be given to you. But I see that as a good thing, meaning all you have to do is commit and be healthy. What other vehicles do you know will allow you to generate or build wealth just off committing, being consistent, and also being healthy? And then the last piece is the right you. Meaning, I guess that's the next slide. Meaning, we can share these vehicles all day long. We can talk about what it takes to be able to achieve or receive a secure compound interest account, how to qualify for one. We can provide we can break down how a home equity line of credit can be effective for you and share with you the knowledge that we've picked up, that we have, that we use, the strategies that we use, that we offer. But none of that matters if you're not on board. None of that matters if your paradigm hasn't shifted. None of that matters if you don't believe that it's even possible. So it all absolutely hinges upon you and your perspective. And what we focus on this channel is education, because the more you know, the more you understand. And please take this information and then go do your own research and then come back to this channel and walk us through what you've learned. But the idea is we're going to give this information away in hopes that when you come back and you've done your investigation, there are no other questions to be had other than, okay, so how do I get started? Go ahead.
Where's all the math that you had on there?
It's coming.
Oh, okay. Well, I just wanted to say this part. I'll make it fast.
Okay.
A lot of people are asking, more of the is it a like the positioning of their questions instead of asking, is this true? How did will this work, right?
Right.
How would it even work? Versus show me how this works. And I think that's probably the difference in the conversations that you have with people. The majority of people who are calling you are saying, I need to know how this works. They're not calling to say, I don't believe that it works. I need you to prove it to me that it works. They're calling to say, I may not understand something. I just need you to clear it up for me and show me the pieces that are missing, because I'm looking for how to get to my goal.
Right.
I'm not looking for all the ways and debunk everything that's coming in my path. I'm only qualifying and disqualifying how I'm going to get to my goal, to 10, right? I am looking at my figures and I understand what my profile looks like. So now I'm trying to identify what those opportunities are for me down out. Can you help me identify what those are and if my profile fits in here?
Right.
Because not everything is for everybody. So we agree with that. Can't disagree with can't disagree. And we understand that not everything is for everyone. But my point is, just because it's not for everyone doesn't mean that it should be for no one.
Right.
And to that, about leverage, just even when you're talking about other people's money, Elon Musk bought Twitter.
With leverage.
With leveraged money. With his collateral. What are we talking about here? And why are we not utilizing the ability to use collateral and other people's money and leverage dollars? Why are these only in terms of bad debt, right? Hanging over our head, and it's not leverage that allows us to move when we need to. That's the part that's sad. So when we talk about the mindset, I think it's what we believe is possible and what we believe is not possible. We're taking it completely off of our plates. And those are the conversations that I'm really more interested in having in terms of how do we help other people see. I think they need proof. I think they need proof that this works. I think they need to hear that more people who are just like them are also using these strategies and they are seeing the results. But until we get people down the line, right? Until we get people committed to building their machines in the same way that we have built our machines, then we won't be able to show them people in numbers. It'll just still be the few people who really took it seriously. And this is going to change a nation. Having access to information. Now I'm a poet. Didn't even know it. Know it.
Well,
okay.
I think we knew it though.
Carry on. I'll stop there.
But I think you summed it up pretty well, because that is the next evolution of this, and that is, so what does that math look like? Because if I think that's where we're headed. Yeah. Yep. So if you remember, what we discussed was, okay, just put the money to work into a secure compound interest account, because Jerry was able to pay their bills. And then over that 10-year period, they amassed about $910,000 in cash value and income of about $83,000. But what does that honestly look like? And okay, we can jump into the calculator and I can confirm and show that, okay, at the 10-year mark, there's about $910,000 in cash value and you have available 83 grand. But what does it look like if they were to start taking income at that moment? Meaning, Jess is now going to start taking this 83,000 as income to pay their bills. I'm not going to really focus on what to do with this 83,000 that is now left over doing nothing, but I just want to highlight what is actually happening inside of this product when Jess starts taking this income. And I wanted to highlight a few years. I wanted to highlight 2022, 2023, and I'm going to, I'll call it, forecast what 2024 is going to look like. So I just wanted to highlight 3 years. And so what does it look like if Jess was going to start taking, let's see how big I can make it. If Jess was going to start taking $83,205 in income, what does this look like? Like actually inside of this vehicle? Well, okay, in 2022, something happened. In 2022, the market crashed. So if she started taking income in 2022, out of her secure compound interest account that had cash value, her cash value of approximately 910,000. Well, this LV, this is the leveraged dollar amount. This is the relock feature. This is the leveraged dollar amount that is provided to you throughout the life of your policy, and it comes at a cost. So inside your secure compound interest account, there are two dollar amounts working for you: your cash value and the leverage dollar amount. So in this case, at year 2022, at Jess's age of, what is that, 20, 28, 38, she would have accumulated somewhere around 910,000 in cash value. If she were to take a distribution of 83,000, remember, it's a distribution. She didn't withdraw 83,000 from this cash value. She borrowed 83,000 from this cash value. But how does the life insurance company keep track of what she borrowed? So again, took the 83,000, went and paid bills. Well, it's a ledger move. So they're going to move the amount that she's leveraged, 83,205, and move that over to the leverage side of the bucket. And so what that means is this, and actually that shows a minus. This should be a plus.
Wow, that chair.
Yeah, I know. Tell me about it. So this leverage dollar amount is now being added to the amount of leverage that I'm already using, which means the leverage dollar amount goes up. But remember, the market crashed. When the market crashed, this cash value, this accumulated value, did not participate in the full market loss. Because of the 0% floor, what that ultimately means is there was no growth in the account for 2022. But I still took income. And when I took that income, the total amount of cash value that I had on my side of the on my side of the bucket dropped from 910 down to 827. But the total dollar amount working for me is the same. These two dollar amounts added together plus these and is the same as these two dollar amounts added together. So the amount of money working for me, even with a down market, didn't change, and I was able to take my income. Again, take it as in take a distribution, borrowed $83,000 from my cash value and used it as income to pay my bills. Well, what happened 1 year later? Well, in 2023, the market did great. In 2023, the S&P 500 did about 14%, but I wasn't able to participate in that 14%. There's a cap on the amount of growth I can have inside of a product like this. Why? Well, if I'm not going to participate in the negatives of the market, there has to be some give. And that give is there's a cap on how much of the positive I can take out of the market. So 19.4% is what was lost in 2022. 13.8 is what was made in 2023. I participated in 10% of it. So what ends up happening is the amount of cash value that I had, remember I ended 2022 with this dollar amount. This dollar amount multiplied by 10% is the growth that's going to be created, or the growth that's going to be added to my account, a total of 238,000. But so, there were some actions that was taken. There were some actions that was taken during that year. One of the actions was I had to take income. I took $83,000 out of this total to be able to use as income. I took a distribution of $83,000. I didn't withdraw $83,000. I borrowed $83,000 from this dollar amount. Well, to keep track of it, I move it over to this side of the bucket to be able to compensate. But something else happened. What also happened is there was a cost to me leveraging this 1.5 million. That cost is 5%. What that means is 5% of the cash value, 5% of the leverage value inside of my account, I owe interest on that amount. There's a cost to borrow. There's a cost to use the money from the life insurance company. That cost in this case is 5%. 5% of 1.5 million is about 77,000. So before I can take hold or have access to the full growth on the account, that 77,000 has to come out, meaning that dollar amount is owed to the life insurance company. This dollar amount comes out of the total before it comes to me. And the remainder, this 160,000, is what I end up making in 2023. So my 827 minus the distribution that I had taken as income, plus the growth for the year gives me an ending balance at the end of 2023 of 905. So I went from 827,000 in 2022 to 905 in 2023. But what happened on the leverage side of things? Again, that 1.5 million, once I pay back the amount that I owe, that 77,000, plus the amount that I leveraged, ends up being about 1.7 million. These $2 amounts are still working for me. And that's even after I've taken $83,000 as income to pay my bills. Well, what happens in 2024? And again, assuming 2024 is going to be a great year. So what happens in 2024? Well, it's the same thing. Regardless of what that growth would be, assuming it would be something greater than 10%, the performance that I would be able to take advantage of would be a cap of 10% inside of this product. Well, 10% times multiplied by the accumulated value inside of this account equates to about 262,000. But what else happened that year? Again, took that 83,000 in income. And when I take this 83,000 in income, it's a ledger move. I move the amount that I leveraged, borrowed, used as income from my cash value and moved it over to this side of the equation so that the life insurance company can keep track of how much I've leveraged for the year. And in addition, there was a cost. That cost of me borrowing this 1.7 million was 5%. Again, why does this work? This only works because the interest that I'm earning is more than the cost or the interest that I'm paying inside of this product. If the interest that I was earning was less, that would mean this number would be negative, which would mean my cash value would continue to drop. This only works because interest versus interest. It only works because the interest that I make is greater than the interest that I pay. So going back to that question of, can my whole life policy do this? I don't care how great your whole life policy is structured. If you are only making a 4% guaranteed return inside of your whole life policy, and it costs more than what it's actually making inside your policy, this process will not work. It only works because I have positive growth. The interest earned is greater than the interest paid. Moral of the story. And so again, following this all the way through, the 83,000 that I had taken in income in 2024 ends up moving over to this side of the bucket. 5% of 1.7 million is 86. And so the total amount of leverage dollars that I have inside of my bucket at the end of 2023 is about 1.8 million. And then once you remove the amount of leverage dollars that I used as income, plus the remaining growth, meaning after I take out what I owe, plus the growth for that year, I almost have $1 million, meaning I'm up to about 9.98 million. And this carries on to in perpetuity. The assumption in these numbers is just stop contributing at age 38. So the assumption is she's not contributing no more 65,000 into this product. But if she did, these numbers would even be larger. If she continued to contribute year after year, even after taking this $83,000, think about it. If she continued to contribute on top, that just means there's more available to her to be able to take as income. Again, there's no wrong answers here. And two, why wouldn't this be a thing? Again, she's putting herself in a position to where she's using leverage dollars. Her cell phone bill, her mortgage, her car note is now making her arbitrage. The arbitrage between the 5% that it cost her and the 10% that she's made, that's 5% arbitrage. She's using leverage dollars to pay her bills, which in turn is putting her household in a position to continue to generate income. Hey, sweetheart.
Hi, and it's tax-free. That's the other part.
And it's tax-free.
If she were to start a business, side hustle, second income stream, she would have to pay taxes on all of this and put extra time in. Do you see how this doesn't make sense to do?
And it's tax-free.
And it's tax-free. Am I lying? Hold on. I want to put.
You are spot on.
Okay. What if you said, what else happened in 2024? Are you done, by the way?
Yeah.
Okay. What else happened in 2024? Well, it is to be determined. We don't know what's happening with the market in 2024. But how old is she here?
So
You're
so
saying,
again, so in 2024, she would be, what is that? 28, 30, 40. She'd be 40 in 2024.
yeah, she's 40 in 2024. They've had enough time for this to grow. They've just gotten married, so we're just going to jump to our situation. What happened in 2024 also is that we just had something happen where we're still processing through it because we just learned about it today. And I don't know, we didn't talk about if we wanted to talk about it, but we're talking about it now.
Yeah, I can
So
feel where you're going. Go ahead.
here we go. I've been processing what happened today, because it's so significant. One, our son totaled his car. I'm glad that he's okay. So let's move past that, because, at first, as parents, you're like, oh, thank God you're okay. And then you have permission to get pissed, right? Like, then you're angry. Like, what were you doing? What were you thinking? How did this happen? When you understand that how it happened was sometimes people just have a lack of judgment, right? And could have done better, didn't do better. And we're all guilty of that. Sometimes they're just not as costly as other decisions, right? As we're processing through all of this today, with everything else that we had going on, of course, the one thing that we did not have to process was something I've never known anyone in my family to not be in this situation. And I had to sit there and I realized I actually have a lot to be grateful for, because the worst thing out of this equation was the loss, right? The devastation, disappointment. He's devastated and disappointed too. And thank God he's okay. But let's just say we had financed this through a dealership. Let's say we had financed this through a bank. This would have looked a lot different. And I think a lot of parents can understand what it is that we're experiencing right now. This would have looked like we had to quickly come up with the 10,000 whatever dollars, right? Because cars are not cheap.
The bank would still want their money.
Yeah. There are no $500 buckets or jalopies like we had access to when we were their age. Let's be real. These are like their cars out the gate, a hunk of junk. It starts at $5K. Cars are crazy right now. So you're not getting anything that's like cheap on Facebook Marketplace. And if it is cheap and you have to fix it, that is not cheap, right? So now it's a whole different equation. They would want their money. You're absolutely right. Not only would they want their money, but to finance, even just to insure, the younger generation, is already a cost on its own. Because we are our own bank, we're the bank. We financed it. So there's no bank coming after us going, quick, where's our money? There's no, it's a different scenario. So in the chart that you were showing, if in 2024, her and her husband, they needed to leverage an extra $10,000, $12,000. They needed to find a car from somewhere. And the rates that are out there right now are not 5%, right?
Right.
We're not seeing any 0% on financing we're not seeing these lower these intro promotional rates anymore. So having access to a loan at 5%, especially if what you're being offered is something like 16, right? Or 12 or whatever it is, but you don't have to qualify for this 5%. You get it because it's yours. That is completely different, right?
Right. There's no application. There's no credit check. There's no DTI related
Right.
challenges. It is yours, and it's available, and it's liquid.
Yeah. Do you need the vibe board to show?
No. So that's all. I was pulling it up while you were talking.
Well, here, we can just go there now.
Now I gotta wait for it to load.
Oh, okay. Well, here's the part. I was sitting here thinking to myself, one, we've officially broken the cycle. Like, we have started a generation of people. Everyone from this point forward should have the same options, right? That's step one. Well, step one is establishing it. Step two is making sure that it will be transferred on to others. I don't know what this would look like in this with the economy the way that it is. I don't know what it would look like if the situation we were in was a situation that I was in growing up. There wasn't access to leverage like that. It was, you had to go and qualify for a loan, right? And make sure that you're making those payments. There wasn't options like this. We didn't have access to options like this. So even though I got big mad, right? I had to just sit with it. And again, this is so fresh for us because we just found out today that all this happened. And Donnell, most of the day, was down there with the tow yard or whatever because they had to tow it. And we really haven't had time to process this. But I just wanted to share this with you guys because this is something that happened and this is something that happens to people. What do you do if you don't have options? If that meant you had to wipe your savings completely out and it couldn't continue working for you. And I think that's really what I wanted you to show is in a situation like this where we can be frustrated because of the impact, but we're not frustrated at the same level our parents were frustrated at because the meaning is different for us. It doesn't mean that he shouldn't have to pay for the vehicle or that there shouldn't be a lesson here or any of those types of things. What it means is this is a moment in time that I'm framing as for us. He don't even have to know. He don't watch anyway, so that's okay. You don't have to know that this is just for us in an official moment where even emotionally what this means and what we had experienced today, the fact that we could still have peace in our day with everything else that we experienced, right? The fact that we didn't have to question or reassure each other that everything was going to be okay. We could still continue on with tomorrow and next year and the year after that, and that doesn't matter. And it's not because we're rich. It's not because we have some insane amount of money. It is simply because we have leverage, we have access to it, and no one can tell us no. We are our own bank. It does not mean
how to use other people's money.
Yes,
that's really
right.
all it is.
And if we were to be trying to save to be able to feel confident enough to make these types of decisions financially, we would never save enough because we would never feel secure that we would have enough saved. But knowing that it's continuing to grow and it's growing without our help at all, when we go in there to say, hey, okay, well, what would it mean now that we've got this situation? Is it as devastating? No, it's not. So is it a loss? Is it an L? Yes, we definitely. There's no denying that part. But is it a complete win for us, for Donnell and I? We're not, again, doesn't apply to him because this is just an L. Life lessons. Okay. For him, life lessons. And it's going to be hard, why he's transitioning into, let me think about things differently. Love that for him. Better that it happened sooner than later, and glad that he's okay. But also just marking a moment in time. And I sat here thinking about this today, and this is the important part. I wish this for everyone. I wish what we just experienced today. I was looking at you and I was like, okay, I know he's big mad too that this happened. I know it was preventable, which is why, right? Because we wouldn't be upset at all if it wasn't preventable. We know that it was preventable now, and so that's why we got mad. And so now we're looking at each other, and I normally would be frustrated, right? Maybe we might have even have had to maybe not go live and help other people because we were trying to work this out and what this means and needed the time to be able to do that. But we had a plan. We understand what our options are, and we completely understand how to take advantage of and leverage what our opportunities. That part right there will allow us to sleep tonight and tomorrow. And we'll be in Indianapolis, through this weekend at this event, and we'll be meeting some of you. Can you imagine what that would be like if we could hand this level of peace to everybody and we could make this infectious, right? And everybody could have this level of security. Doesn't mean they have to be rich. It doesn't mean that they are living in a mansion. We don't. It means you have financial security. It's completely different. And it's redefining what wealth actually means. It's redefining where you get peace from. It's a different kind of peace, right? This was so, as crazy as this sounds, this was just the weirdest day, because this was the most wholesome experience I've had with something like this. Having it not be trauma, having it not be yelling, having it not be a lot of things that it would have normally been in the past. And the factor in all of that wasn't that I was just tempering my emotions and how I was feeling about it and being, emotionally responsible and mature as a parent. Sometimes we all lose our, we all lose our stuff, and we have our moments. It's frustrating. It's frustrating being a parent sometimes. And today I realized that a lot of the moments when I would feel frustrated in this situation, I was really breaking myself down, because it's the right mindset, right? The right vehicle. I realized that the reason why I would have normally been so angry, that I would have been probably yelling and lecturing and extremely upset, was because in that moment, I realized that what had been taken away was control. And that I can't control. I'm now out of control. I felt in control, and then now you did this thing, and now I'm completely out of control, and I don't have control anymore. And now somebody else gets to decide what our options are or are not, what I can and can't do, how I can and can't advocate for you or help you. Now I'm in a worse position, or somehow a rug has been pulled out from underneath me, and I felt like I was finally making headway.
Right. I was building momentum, and now all of a sudden I'm pulled back, or I have to go back to start.
Right.
I'm moving through my maze of achieving my goals, and now I get pulled back to start. I get rubber band back, right?
Yeah, like does that make sense? Here, I'm gonna go back. Does that make sense to you guys? Do you I think most people can relate to that. It's that moment where you feel like, I'm working so hard to get us to the goal, and somebody in our family even will come in, swoop in, and like crabs in a damn barrel. And you're just sitting there thinking to yourself, like, dang it, if you would just help me get to the goal, we could get there faster. But unfortunately, I have nothing else, no other options other than to deal with you and your BS right now. And so it has to become part of the equation. So which means if you're losing, I'm losing. We are only as strong as our weakest member of our family. It doesn't matter how strong the strongest member of the family is. We are not the average. We are only as strong as the weakest member in the family. And so therefore, we have to still bring you along. The strongest member does not have any advantages over that. We still have to come down here to where you are, right?
It's the boat.
Right. So in this moment, though, it was so different today. And I'm grateful for that. And I was sitting there and I was kind of ranting about it, like, golly, just the fact that we had to have, 4 hours today was just dealing with all of that.
Easily.
Yeah. And we, of course, we got to pack. We got to go, get on the plane early in the morning and the whole thing. So this wasn't like really in the cards, wasn't really on my bingo card for like how to get all this stuff together, right? And be prepared. So I'm like, oh, the inconvenience too. And I had to pause. I had to just have a moment and think about it. And I haven't had a chance to talk with you about it because we've just been going. And then it was time to go live. But I felt like it was important to share with you guys because this is real life. This is really what, we're not the only ones going through stuff like this. The difference, though, is we're just a few years down the road from a lot of you, just a few years, and the impact that a few years has had to be able to have this level of peace and security and options and control. That's the part.
Get self-directed.
The rug was not pulled out from underneath me today. The rug was not pulled out from underneath you today. There was nothing that, the only thing that would have impacted us today is if he wasn't okay.
Right. Right. That's the part.
And he was. And so that was the worst case scenario had been taken off. The only scenario where we didn't have control had been removed. And for that to be the only thing, right? People say, oh, money can't buy happiness. Money can't buy health. They can't. They can't. I mean, I can see where people say those things. You have access to health care, things like that. But in a moment when your babies are hurt or injured or worse, right? Being able to have access to whatever is necessary is important to get the job done. Whatever it is, so that you have control over the options that are available to you. And there is not another person, not a doctor, not a hospital, not an insurance provider, not a car dealership or their finance department that can tell you what it is that you have access to or don't have access to. You're not having to take the options that are just available to you because that's all you really qualify for. Because you understand that sometimes buying the cheap car, buying the bucket actually ends up costing you more money down the road after you fixed it 42 times, right? Like we get it. But if we would have, instead of putting $15,000 into a $5,000 car to keep it on the road, like you just get down the road and it happens, right? It happens.
Right.
$1,000 at a time. And you think it's only, okay, it'll just be that. And it never does. And people get sucked into this all the time. They get sucked into this with their houses and refinancing for their house. And then they end up having to pay refinancing fees all over again to refinance. And they think that they're doing something special because it's saving them money every month on their mortgage. But over time, they're actually paying more. This is normal. And the reason why we take advantage of these things is because it's what is available to us. It's what they're saying is available to us. We have other options. We do. And we just have to learn how to piece them together, whatever it is, how the puzzle pieces are shaped in your life, how to fit them together. And you don't have the rug pulled out from underneath you. You don't have the rug pulled out from underneath you because you have control. That's it.
And that is the premise of getting self-directed.
Right. And today was that proof. It was a moment of proof where I was like, we've seen this before, but not at this level, because this for me wasn't just a parenting moment. This for me was, if I were his age, right, having this experience and needing to, and something significant happen, like an event like this, remembering where I came from and going, how huge this would be. Never. It was just a moment for me. So I had to log it. And thank you for letting me share it with you guys. Again, when I'm going through this and I'm realizing I actually have so much, I could be big mad. I could stay big mad, right, at him and upset at the choices that he made. And kids, they do things. They're learning how life too. And I get that. So without being too judgy, it's being grateful. I landed on gratitude. It was a gratitude adjustment for me. And I landed on gratitude because there is a lesson here for us all. A few of them, actually. Probably you guys are picking them out already. But what I realized was this feeling as I sat here with it for a moment. And I thought about the contrast of what this would have felt like otherwise. The first place that I went to was, I want more people to feel like this. I don't want to hold on to this and say, gosh, didn't this feel good? Let me tell other people about it. The best thing we can do is continue to get out here and teach other people how to do it too, because everybody deserves this. Everybody deserves this. Peace, control. And that's what we're out here for. So I'll leave it there, but thank you for letting me share. And if your kids are out there doing some kooky stuff too. We don't have a support group. Maybe we should start one. Yeah. Okay. So back to the calculator.
Or the questions, because so all I was going to share as it relates to the calculator is 2024, 2 years older than 28, so or 38, which would be 40 years old. If you move the calculator 2 years later as well, because this is at age 38. So at age 38, this is that 8325 that's available to take as income. And this is that total cash value that's available, the 910,000. But if you run this out an additional 2 years, it's a game changer because the calculator assumes, okay, then that means I'm contributing 2 more years. So it would look even crazier the amount of income available. So now we're talking about 115,000 that's available. Even if she only wanted to take 83, there's 115,000 available and 1.2 million in cash value. And if you look at the projected match value, so meaning what's the accumulated value that's actually would be working for them at this point? It's these $2 amounts together. This is where the income is coming from. This is the leveraged dollar amount that she has in addition that's actually having the impact on this side of the equation here. So again, the reason these numbers look different is because this side of the equation is assuming they're no longer contributing. My point is, if they just continue to make this contribution year after year using the dollar amount that's in the leverage dollar amount that's in the secure compound interest account, we're talking about even more. So these numbers end up getting, I'll call it ridiculous as it relates to how much is available for income, even though the goal at that point was only 83,000. So that was the only other thing I wanted to highlight there. So we can absolutely jump into questions, sweetheart.
Okay. Well, there's some really good comments too, but let's. Brenda was just saying, please, and please give your son grace. He is processing the disappointment as well. I was that mom too. And man, I think that part right there, like parents having peace is, I think, one of the best ingredients or gifts that we can give and ensure that we have. Because I don't know that going through all of that emotional processing that we're doing of like serious financial devastation on top of all of the other factors, right, allows us the capacity to even be aware of what they're processing disappointment. We'll process it while you're helping me get this this car back, right? This money for this car. Like, I don't know that we have the mental capacity. I think we all have a limit, and taking away those factors alone, I see now how there's an open runway. So Brenda, to your point, there's an open runway now for me to take a moment and go, how are you processing this? Because instead of being defensive, right, deflective about my energy about it, now we can make this a teachable moment in a different way. Yeah. So it's such a good point. And thank you for bringing that up, because having grace, I think, is forced grace or fake grace, right? That you're just like pretending and trying to allow that to happen, hoping it will just kick in when you are highly frustrated and devastated yourself, is really difficult. But the absence of those, and I'm just trying to find all the words. It's still so fresh, I guess. The absence of that trauma and that frustration and that fury of, I got all the way here to be knocked back. I remember my mom feeling like that. I remember, and I had no idea how hard she was working. I just knew she was my mom, right? I just knew that was like my family, that we were all we had for each other. And so I don't know how devastating this is, or I could imagine how devastating it is, but you don't know when you're watching, your parents freak out about something and you're just like, gosh, once you once you get older, you get it. You understand like why that would be, why they might have reacted that way to certain situations. And now I understand why this work is even more important, because it's not just about money. It's not about money. It's so much bigger than that. And it's just, it happens to be that money is the vehicle. Money is the currency that affords the grace. Money is the currency that affords the peace. Money is the currency that is the foundation for you to keep standing, right? For your feet to be firmly planted. It's different, and it doesn't take that much more money. That's the craziest part about it, is it's just learning how to do different things with the money you already have. Why aren't they teaching this in school?
Who benefits?
Who benefits? But it's just sad to see how many families, marriages are torn apart because of financial trauma. And they could have been in a completely different situation, had leverage, known that everything was going to be okay, and not been devastated in the same ways just by having access to information. And it's crazy that when we are out here sharing it, that a lot of people are like, what are you guys talking about? Nobody's done that. Nobody's doing that. We're doing it. We're only talking about what we're doing, by the way. So even reverse velocity banking, we're only talking about what it is that we do. So that's, if we needed to have proof, we are the proof. In this moment right now, today was even more proof that it's not just about the money. It's not just about the financial security piece. It's about all of the other things that come along with it. Gifts with purchase. Gifts with purchase. Okay. Rose had an interesting question. I don't know, Rose, if you're still on. Antonio Rodriguez, he jumped in the chat. We haven't seen him for a while. So, hey, Antonio, if you're still on. I asked him earlier if he would mind answering her question for her, because I know he's in that
space.
Yeah. Mm-hmm. She said, does it make a difference if you use a first position HELOC or a second position HELOC when paying your mortgage? That interest in a HELOC is tax deductible is the interest tax deductible like mortgage interest?
So it's interesting about interest being tax deductible. So speaking from a perspective of, we have a first position HELOC, sometimes the interest inside of my first position HELOC that I pay back to the bank is tax deductible. Sometimes I'll call it, it's a fine line that you walk, because if you are solely using this first position HELOC to focus on paying it down, meaning the money going in is only going towards, paying down the home equity line of credit, then you absolutely can deduct that interest. But if you use that debt tool for anything else, in this case, buy a car or take a vacation or pay other bills or knock down other debts, then what you're doing is you're transitioning out of being able to write off that interest. So it's a fine line, and you have to have I'll call it some decent bookkeeping around how that process is working to be able to write it off. So it's one of those questions one of those answers that I really hate providing, but it's the truth. Because it depends. It really depends. There's no straight answer for that. So.
Yeah. But Antonio's answer to her was, why would you, if you shouldn't be doing it for the tax advantages, you should be benefiting far more, right, from using it as a tool than you are from the tax advantages. So I thought that was a great point too.
And that's the conditioning part, right? We've been conditioned to, hey, I want to make sure I'm not giving the bank more interest than they deserve, right? Because they're taking advantage of me. So I want to make sure I'm limiting their ability to take advantage of me, not realizing the other end of that spectrum is, you know what, if you're really putting this money to work for you, you're going to outperform whatever that dollar amount is you're giving the bank. It's going to pale in comparison to that vehicle that you're getting this money compounding in, or that debt you were able to eliminate. So you're absolutely spot on with that.
Yeah, man. And sometimes we will do that. We will get short-sighted in that way. Yeah. True Women of Substance says, I can pay everything but my credit card bills from my debt tool because I don't have a line of credit with an attached checking account. Any suggestions?
I think that's okay. I think sometimes we get caught up in because when you listen to the velocity banking gurus, the idea is all of your income is supposed to go into the debt tool, and you pay bills from that debt tool, and that can cause people to I'll say become stagnant or not be able to progress forward because for some reason they feel as though they're not following velocity banking to a T. And to me, I'm a common sense guy. There are times, well, there are a lot of times where I will share with people, maybe you don't want to use a debt tool at all. Maybe you want to use debt snowball. But bottom line is, don't allow what bills can't be that can be paid through a debt tool to stop you from doing velocity banking. Just maintain that dollar amount in your checking, pay those bills as normal, and do velocity banking where it needs where you can. Because remember, velocity banking is about the debt tool. It's about paying down the balance on the tool, whatever it is. So if you have to leave a certain amount in your checking to pay the bills, that's fine because that dollar amount wasn't going to be sitting on the debt tool anyway.
Right.
Key is, where's your cash flow? The cash flow has to be sitting on the debt tool, drive the balance down, and then you chunk away at other debts as that balance drops.
Yep. Okay. Today, she had to leave, but she's here and she's going to watch the replay. So we're going to cover her questions and her comments. When we were talking about employing your money, like starting a business, but without having to even start a business and having probably way better, much more fruitful experience and profits doing it this way and getting a strategy around how to make your money make its own money versus how to add more time or trade more time for money, right? You can do both, but one's more guaranteed than the other, right? She says, I see people around me every day struggling just like us. Every day is a new thing to figure out. Inflation is killing small businesses. It's not just inflation. It's also the landscape of learning how to market and branding and competition. There's a lot of things that people did not expect. Pizza shops that have had to close down, not because they haven't been in business for decades, but because there are location situations or lease situations that they faced that they did not have to, they didn't expect to have to deal with these types of things.
Right.
So was it about the business? Were they good business people because of this one particular thing? No, but it didn't change how this was impacting them and their families and their future, right? So, it's just a good thing there's a lot of people out here selling courses on how to start a business and all this stuff, but their business is on how to sell a course for business. Like make it make sense, okay? And if that's the only thing that people are out here doing, then show me where you've built a business, man. Show me where you have done this work. And there's far too many people out here who are talking about things that they are not even doing or only able to do them because they're talking about them. And that's not okay. That's not okay. We need to stop that, and we need to get more doers out here talking about the experience of actually doing it, so that we know, what, this isn't a vibe. Like we learned with those fire people, they were quitting fire. They had retired early because they thought talking about the fire movement would give them the income that they needed in order to be able to retire early. But the second that these platforms stopped paying them to do this content, then they went,
shifted.
Holy cow, hold on a second. Fire doesn't work. Did it ever work? Maybe for some people who weren't doing it this way though, right? You were selling how many people a dream and you weren't even actually doing the thing. Hey, I'm just here spilling the tea. I didn't make it. I'm just pouring it up. All right. So Tadam's, hold on. Tom says, how does a properly structured SKIA compared to similar structured whole life policy for infinite banking? Does a SKIA take longer to break even to leverage?
So it's actually the opposite. So in most cases, I'll call it a properly designed whole life policy breaks even around year 6, 7, properly designed. I say poorly designed somewhere around year 10 or later, but somewhere around year 6, 7, a whole life policy breaking even, that's a really good whole life policy. Whereas in a secure compound interest account, in general, unless there's a some factor that causes this policy to not compound the same. Meaning, for my older clients, in order for a policy to break even early, they have to be a lot more intentional as to what it is they're contributing. For clients who maybe they have health related issues, so their rating is less. But if we're talking about on average, a properly designed SKIA, most break even at year 3. You can't find a whole life policy that breaks even at year 3. And the reason a properly structured SKIA breaks even at year 3 is because of the leverage that kicks in at year 3. Excuse me. So there are factors here that allows a SKIA to break even that just doesn't exist in other products. And so, and again, a SKIA is just a properly structured cash value life insurance product, traditionally an IUL on steroids with leverage. So let's take whole life policies out of the mix. How does the SKIA, a secure compound interest account, like a premium finance strategy like MPI, compare against other IULs? Well, a properly designed, a max funded option B IUL, properly designed IUL, on average breaks even around year 5, maybe year 4. But again, I go back to, in a secure compound interest account with leverage, breaks even at year 3. Still, again, so they just do not compare. And what I love about this question, Tom, is it all depends on the structure. And when you add leverage to a properly designed product, it looks a lot different. So
Okay, trying to read the comments.
I know.
I get in here and I'm like, what are we doing, guys? What are we talking about in here? By the way, we don't know if you're watching, and if you don't jump in the comments or the chat. If you're watching the replay, you jump in the comments and let us know what you thought. What are your thoughts, your opinions, feedback, any of that. But if you're here watching live, we don't know unless you jump in the chat. So do that, because we like it when you do that. Okay. True Women of Substance says, and for all of you who are in the chat, thank you so much. I need to, there's a little something. Okay. I can pay everything. Oh, wait. No, she was asking again because she was like, clearly my question got buried back there.
Yeah, got it.
Girl, we got you. We started a long time ago. We just didn't get to that part. Okay. Richard AP. Oh, it's the cute little boy in the graduation. Okay. If the interest owed is deducted, paid with the earned, why is it added to the loan value amount, leverage value amount?
The interest owed is deducted, paid.
If
And that's just it. So the interest earned. So let me back up a little bit.
You want me to go the vibe board?
No, not necessarily,
Okay.
because I think I can kind of break this down, and let me just make sure I got it. Interest owed is deducted. The thought process here is, as interest is accrued inside of the product, it's deferred. But the life insurance company has to keep track of what's there. So it's a ledger move. And so once you generate more than whatever that cost was, it's taken out of the total, because the accumulated value is based off your cash value and the leveraged value. So both of those dollar amounts are what's working for you. So when the growth happens on both of those dollar amounts, there was a cost to you for using that dollar amount. The life insurance company just wants their interest. And that interest, here's the cool part about the interest paid back to the life insurance company. It's not paid and then taken out or used outside of the leveraged dollar amount, meaning that interest that you paid back to the life insurance company is still working for you, because it's still a part of the accumulated value. And because it's still a part of the accumulated value, yes, you paid it back. Yes, the loan became self-collateralized. Yes, you no longer owe back to the life insurance company. That interest continue working for you year after year after year. So not only was it paid, it also, you're making arbitrage off of it, meaning that's that OPM piece. So you're not only making OPM off the leverage dollars, you're also making OPM off the interest paid on the leverage dollars as well. So it's almost like a double dip in some cases.
Yeah, you should have showed, because it's really hard to imagine what you're talking about. You could have showed it to us. Do you guys want him to show it to you? This just in. They were like, yes. Okay, maybe they'll have follow-up questions. Okay. So, well, I just want to bring up Jewel says, "Oh my God, thank you so much for this story, Angelique. I can relate so much. You're reading my mind. I thought I was the only one feeling this way. This is why community matters so much because sometimes we don't even know what the options are or the opportunities are when we think it's all us that's the problem, right?
Right.
But when we're out here and we realize no other people have this problem, then we've got to figure out some different solutions. And that's the root of where MPI came from, even. It was one brother was having one experience and the other brother was having a completely different experience. And he said, well, why can't you do what I'm doing? He says, I can't do what you're doing because you're in a different position than me. So I will never be able to do what you're doing because I don't qualify to do that.
Right.
And with my career and what I have available to me, I won't be able to. And he was like, we're changing that. The end. That's done today. We're going to figure this out. And they did. And that's how MPI was born. Here, well, hold on. And that's how MPI was born. And that's the story of MPI. Okay, Jesus says with a credit card, you and park your cash flow and credit expenses on the main credit card. Anything that is cash expense, you leave it in your checking account and pay from there. Hope this helps a little. Yeah, see? Each one teach one. We love to see it.
Yep. Don't allow not being able to pay a certain expense from a line of credit or a credit card to prevent you from doing velocity banking is the moral of the story.
Yeah, take action because time is the most valuable asset. In all of these equations, it's time. We're being charged for time, we're being penalized for time, or we're benefiting and we're using time to grow. Hope I sound loud. Am I loud? Squirrel. Okay. Define the break-even point for a skia. Now, Charles had a couple other questions, okay? Mm-hmm. So I'm feeling like we can just go ahead and handle all Charles' questions. First up was, now that I'm scrolling back up, now that I'm going in order now, my bad. Sorry, Charles. Okay. What was her yearly contribution? All right. Then it was probably when I cut you off and he's like, yeah, thanks. But he mentioned, what if the yearly contribution continued for 2 more years? Can we see it? Can we see it on the board? Pull it up and then define the break-even point for a skia. And I think all of that is right there on that vibe board, isn't it, Donnell?
Let's go to it. So let me go back to the original. So the original example was Jess putting away her income, which is $65,000 a year for the next 10 years. And if you want, sweetheart, you can just go to the calculator. So it's putting away $65,000 a year for the next 10 years. So how much is that? What does that look like? So in this case, $65,000 divided by 12 is about $54.17. So again, the thought process of the goal for both Jess and Jerry was they're going to pay all of their bills for the next 10 years using just Jerry's income, his 83 grand. And the objective was, hey, at what point inside this vehicle would we have $83,000 available in income to be able to receive out of this vehicle to then take care of those bills? So in this case, we're going 28 to 38, so 10 years, putting away $65,000 a year, which is $54.17 a month. So over that 10-year period, make it a little bit bigger. Over that 10-year period, too big. That $83,000 is what would have been accumulated, or at least that $83,000 is the amount of income that's accessible inside this vehicle, along with $910,000 tax-free in cash value also sitting there. And again, that $910,000 plus the 1.476 million, these are the $2 amounts that are working for her and what's allowing her to be able to generate that $83,000. So hopefully that, and then break-even points. Let's talk about the break-even point. So let's come up here and so she's at age 28. Let's take a look at age 29. So what happens in year one? Well, in year one, she would have put in $65,000. Come on. She would have put in $65,000. So notice, in year one, put in $65,000. She does not have $65,000 working for her. So did not break even in year one. Lost about, let's call it $2,000, $2,700. No, about $1,300 lost in year one. Okay, here comes year two. Again, age 28 to age 30. Would have put in 65,000 times two. What does that look like inside of a vehicle like this? So 65,000 times two. Notice in this situation, at year two, she broke even. So why? Well, it's because of the design. Max funded, option B, IUL. What does that mean? Max funded. We're purchasing the least amount of life insurance legally possible. How does purchasing the least amount of life insurance legally possible help you be in a position so that you could potentially break even early? Well, you have to look at it from the perspective of the people who sell life insurance. What is the goal? What is the job? What is the opportunity for people who sell life insurance? Well, if I'm selling life insurance, my job, my goal, my focus is to make sure you buy as much life insurance as possible. So regardless of the dollar amount you're contributing, the more life insurance you buy, the more expense to you. The more expense to you, the more money I make is commission. But this is designed 180 degrees opposite of that. The goal is to purchase the least amount of life insurance legally possible, because the less life insurance you buy, again, max funded, the less life insurance you buy, the more of your money goes towards compounding and making money for you versus expenses. So therefore, you're putting your money in a position to break even earlier because you're paying less in fees. So why don't we break even at year three in a regular IUL? It's because it is not designed so you're paying the least amount of fees in this product. Why don't you break even at year three in a whole life policy? Because it's not, most people who sell whole life are selling life insurance. It's just that this life insurance is structured such that you can now use the cash value, go do infinite banking. But it is not a max funded policy. So then 9 times out of 10, you're buying more life insurance than you should. So therefore, you're paying more in fees. So therefore, your cash value isn't working for you. Whereas in this case, this has to be structured differently. It has to be structured such that you're paying the least amount of fees. And then at year three, she would be 31. At year three, when that leverage kicks in, it's game on, because now at this point, every dollar you're contributing is just making you money, because you've moved beyond that point of meaning once you break even, now from here we start building secure compound interest, meaning your money starts making money, and the money that your money makes more money. But if you don't break even till year seven, how's your money supposed to double? If you don't break even in your policy till year seven, how much longer is it going to take for your money to double one time? Approximately 7 more years. So it took 14 years for my money to double once. Whereas if I break even at year three, break even at year two, how many more years will it take for my money to double one more time? So it's all about compound interest. It's all about your money making money for you. And so again, it's all about your money becoming employees, and those employees going out and recruiting more employees to make more money for you. So the only way you can do that is through structure. The only way you can do that is make sure that you are putting your money in a position such that you're paying the least amount of fees. The less fees you pay, the more money you make.
Yeah, this is the biggest lesson in the book, The Richest Man in Babylon, right?
That is true.
Yeah. So even though it started with pennies, right? There's the question people ask, social media posts: would you rather have a penny double every day, right? Or
For
would
30
you
days.
rather have, yeah, for 30 days, or would you rather have $100 or $1,000? And people usually would just, because they're doing the surface math, right? Pennies, give me the cash. But because maths, then they end up losing out. And that's where I see a lot of people when they're looking at the concept of infinite banking. You can infinite bank with this, okay? Sorry, it's that way. With this. But that part's not even the important part. The majority of people, I feel like I need to clap when I say this. The majority of people who say that they want to be involved in some infinite banking, probably the majority of people who even talk about infinite banking, let's be real, are not even infinite banking. They're not even using it. They're not leveraging it because you have to be able to have a deal that is producing more profit than it's costing you to borrow the money in the first place, or your policy will just implode. Then what is the freaking point of all of the money that you put in? It's just an extremely expensive term policy at that point, because sometimes it doesn't make sense. It doesn't make sense. You could get cheaper money somewhere else, or you can leave it in there so it can continue to grow and it can be its own thing. That's fine, right? But what we can't have happen are people who are losing their policies, losing their coverage, and then their loved ones are out here doing a GoFundMe when you were just an infinite banker 10 years ago, right? Make it make sense. Look, I'm gonna stop there. Okay, so we have more questions. Thank you for all your questions. Oh, we have this comment right here from Peaky. Hi, Peaky. It says, money may not be able to buy happiness, but it definitely can buy clarity of mind. Yes, it can. And losing that could definitely rob you of that, right? So you're feeling really confident and you go to do this infinite banking and you have no idea what you're doing. You're going to go buy a real estate property, but squatter comes in, sits in your property for 2 years, and you've got to pay an attorney to get them out and go through the legal process. And now all of a sudden, how are you going to pay that loan back? You never will be able to with rents. You can't. You don't have the buffer for risks like that. So a lot of the people who are talking about going and using these, there are just different vehicles, and they're structured in different ways so that it protects you in situations like this. Infinite banking is fine if you're just trying to do something that makes sense. It's small, it's less risk. But the majority of people who are out here, if you ask them, infinite banking, okay, what do you use it for? Tell me some deals, some things that you have used it for. They don't know. Am I lying?
No.
Even the majority of people, when they call you and they say, oh, I want to do infinite banking, so that's why I was looking into a whole life policy, and you go, okay, that's great, because it's a great vehicle if you have the opportunity to use it. So what are you going to use your policy for? To infinitely bank on yourself. And they go, oh, I don't know, right? I don't know. I just want the ability to be able to do that. I don't know. I bought that dang, what's that pressure cooker thing that we got down there on the counter? We bought it for the ability to pressure cook stuff, but I feel like I'm just putting a bomb in the kitchen, and I'm so afraid to even be in there when it's cooking, so we don't ever even use it. So it really is just sitting in there, but I wanted it for the ability to be able to, right? I bought the gym membership for the ability to lose weight, but if I'm not going and using it, then I'm not getting the results, and what's the point? I bought all of these things for the ability to leverage them. But if we don't actually get to leverage them, then what is the point? And there's so many people out here talking about the benefits of it, and they are good salespeople. They're great salespeople. But the majority of people cannot use them for the ways that they're talking about that you can use them for, which is fine. It's fine. But we do not want to be in positions where we have to then go learn the real estate industry in order to make that make sense. We don't want to have to be in a position to go learn a whole new freaking career and be an expert at something so that we can protect ourselves, right? Just so that we can go and make a spread, a small spread. At that, we're right back into the same conversation of starting a business, right? Versus employing your dollars to go and make money for you so that you are not having to go learn a new industry. It's to set it and forget it. You don't have to even read the instructions. That's the part, is that there's nothing in here that's the dangerous part. How you leverage it. Oh, and I like this question because this is leading right up into whose question was it?
And I appreciate you, sweetheart, because I've been trying to restrain myself from getting into that infinite banking argument. So I appreciate you wrapping it up.
Oh, and well, okay, well then we'll just wrap it up with this right here. this last piece. Okay, we're back into it. If there's no such thing as an infinite banking policy, so that's just a reminder. If you call your insurance company, matter of fact, they are now putting this in the language of contracts because they never agreed for you to use it like this. That's not what it was designed for. So if we're talking about infinite banking and we're planning on leveraging it this way, even credit cards are doing this with velocity banking. They never agreed for you to use those for velocity banking either. So now they're coming down on people and limiting their lines of credit as you pay it off instead of you having that room to fill it back up to add and dump. They're just lowering the limit because they can, because they get to make the rules. And when they get to make the rules, you got to abide by them. And that's the difference, I think, is when we are out here doing things with things that were never designed to be used that way. Can you? Yes. Did Disney, all the stories that people tell? Yes, they did. They were able to leverage them. But now that they're being over leveraged and now that people are being irresponsible with them, for many reasons, right? Some of them ethical, maybe some of them not so ethical. Who cares? It doesn't matter. That's their business. It's not going to be yours because you're learning a completely different strategy. That's it? Okay. And that's that. That's the end of that.
Next question, sweetheart.
Okay. Been working with Amy, set up something really nice. I've also started 5% contribution in the 403B. Employer offers with 25% discretionary match of my contribution up to 4.
Perfect.
Okay. So is this a follow-up?
Yeah.
Okay. I'm not the one starring all these, so I'm just on an auto increase by 1% annually until I reach 10% contribution for now.
So, and we're talking, I think that was so working with Amy. So, this is New York. I remember now. Okay. So
New
tell me
York.
this, that sounds like there's still an opportunity there for a self-directed opportunity as well. Meaning, because it sounds like that 403B may be tied up in the market, there may be an opportunity for you to also take a look at, is there a self-directed IRA or self-directed 401k opportunity to be able to move money out of the market so you can use that as a vehicle to shift funds over to be able to grow wealth there as well.
25% discretionary match.
It's pretty good.
Yeah, 25%. Go you. Where do you work? Maybe we'll some industries too. That's another thing is I don't know why I put this down. Okay. Some industries I had no idea, like for instance, teachers, who knew? Raise your hand if you knew that the state will pay for your down payment on a house if you are a teacher in Texas. Did you know that? How many people did not know that and probably would have at least gone in to be a teacher first and then switched off and changed careers just as like a strategy move? Like who wouldn't be doing that? Do that, by the way. Follow us for more life hacks. Okay.
Be careful, sweetheart, because there's a cost to that. This goes back to that tenure piece, right?
Yeah, but no, these people were coming in getting it early on. I'm sure different states have different programs.
Yes.
But who knew that there were? I know that there's some loan relief programs for teachers, right, and for government workers. But I did not know about the housing programs that existed for some states, far better than others. And that's crazy to think about. That really no one's out here talking about it. And I would think that there would just be people who would like to have that option over not having that option at all, right?
Absolutely.
Yeah.
Absolutely.
Okay. So, Anthony Dottie says, Dottie. What do you guys think it is? We voting? Okay, my bad if I mispronounce your name. Anthony says, what do you do with the paid off credit cards? Just leave them or use them for something? I have one credit card dedicated for bills.
Yeah. So what I can only speak from my perspective. As we would pay off debt, my objective was to go back to those credit card companies and get my credit limit increased. So, because what I'm looking for is leverage. So, do I need it? I don't need it. But that moment that comes about where I might, I now have the leverage available to be able to use it to do whatever I want. So, the key for me is I don't close any cards. I may stop using them as often as I was, or I try to spread my normal expenses out on each of them just to continue to keeping them utilized. But my objective has always been to increase the limit. I want higher limits as I'm paying off, paying down, reducing my utilization on a card. I want to increase more space in case something happens. I just want to be in a position. If you stay ready, you don't have to get ready, right? Put myself in a position to where if I need to pivot and take action, I have the ability to do so, whether that's using a credit card, a line of credit, doesn't matter. A home equity line of credit, personal line of credit, BLOC, doesn't matter. It's having access to the leverage so that you can take action if you need to.
Yep.
That's also
Okay.
how we became hard money lenders. Because think about it. I've got a free and clear credit card that maybe still has 12 months of 0% on it. How easy would it be to become a hard money lender for a short term and make money off someone else's money?
Yep. Um, there's a lot of really great feedback in here, and I really appreciate it. I'm looking for there's questions people are asking about in the chat, but I don't see them. So if Justin, if you're still on, you could help me flag those and find those. That would be great.
And so this one, so does the money get leveraged monthly or only annually? It's your choice. So it can be leveraged weekly if you would like. Now, here's the truth about this process. As of today, we are educating a life insurance company on how to distribute income. So as of today, if and using Jess as an example, that $83,000, if she wanted that dollar amount split up as a monthly amount, so divided by 12, she would have to initiate the distribution of that 1/12 amount every month. So we are in the midst of educating a life insurance company on how to distribute income. In the future, what this would look like is, hey, if it's $83,000 a year, I'm setting up whatever that system or that term is that I want that 83,000 distributed, whether it's biweekly, weekly, monthly, quarterly, whatever that time frame is. And what that means is on whatever that frequency, that dollar amount is just direct debited into my checking account or direct deposited into my checking account on that frequency that I set. We are not at that point yet. So as of today,
I don't know what happened there. We lost you.
am I back?
Yeah, you're back. We lost your audio just at the very end. It's going to be okay. Emmanuel's like, no, we're good. This just in. Emmanuel said, we're good to move forward. Thank you, Emmanuel. Okay. Rosalind says, last week you mentioned that it takes an MPI specialist to trigger the leverage. Why is that if the life insurance company owns the product? Don't they know in
Oh,
year
perfect,
3 that the leverage should kick in? Yeah,
perfect.
Donnell.
And this
I love
and
this question.
absolutely. Because what's important here is you have to understand what it is you're buying. And this also speaks to this perspective you had around whole life policies. There's no such thing as an infinite banking policy, no such thing. There's no such thing as an MPI policy. There is no such thing. MPI is a strategy. Maximum premium indexing is a strategy applied to your cash value life insurance policy. So, what are you buying? You're buying an IUL, an indexed universal life insurance policy. Those are traditionally structured the same way, they function the same way. That strategy of adding leverage, someone who's qualified, who's certified to be able to do so, has to request the amount that's going to be leveraged. There is a process to be able to add that leverage. It's just it isn't a matter of reaching my hand in a pot and dropping that dollar amount into your bucket. What has to happen is we have to request the dollar amount that you're eligible for, and that just looks like filling out a loan form. It's really not complicated, but we have to request that dollar amount, and then when we request that dollar amount, all the life insurance company knows is you're leveraging borrowing against your policy. They don't know what you're doing with it. So we have to intentionally put it back in as brand new principal. That's a process. Meaning, so we're going, in addition to your normal monthly contribution, we're also going to add leverage dollar amount going in as contribution as well. That's its own set of rules. That's its own set of that's its own process. So therefore, it requires someone to manage this process. This is not something that you just turn the key and it automatically just happens. Now, as MPI evolves, it will become more turnkey. But as of today, this process has to be managed, and it has to be managed by someone who understands what it is they're doing.
Okay. There's a few people asking about Richard's question. Richard's got the questions. And it's follow up on the questions about the leveraged interest. If it is deferred, then why is there deduction made to your interest earned?
So look at it from the life insurance company's perspective. It's deferred. How does the life insurance company keep track? How do they know how much has been accumulated? Well, what they do is, again, it's just simple accounting. It's a ledger move. I'm going to move the dollar amount that you've now taken as income, and I'm going to move it over on this side of the balance sheet so we can keep track of it over time. So it's how the life insurance company, it's just simple accounting. It's a life insurance company keeping track of how many distributions you've taken, and it's no different than the balance sheet that a bank uses. Your deposits compared to your withdrawals, compared to your loan amounts, compared to the interest accumulated, and it's a balance sheet. So it's keeping track of where the dollars are so that when it comes time to, I'll call it, God forbid you passed and there's a death benefit that has to be paid out, someone has to then calculate how much interest is owed. Well, there's nothing to calculate because we've been making that adjustment throughout.
It's a great question. Understanding why it works too is one thing. Knowing that the insurance companies have agreed to do this is completely different. Unlike infinite banking, the reason why we have this calculator is because they've approved this calculator. I'm not throwing shade. I saw the look you're giving me. The here you go look, right? It's not shade. It's just the truth. Isn't it approved? The calculator.
Oh, absolutely.
The calculator is approved from the insurance company. It's an industry approval, so we wouldn't be able to use it without it. So that's another thing that you can put in your notebook. Okay, related to the SKIA relock, when is the leverage applied annually from year 3, 5, etc., or monthly from year 3, 5, etc. on, assuming paying monthly year 1 and 2? Ooh.
So the call option is done point to point, meaning if you're contributing on a monthly basis, let's say you contributed on January 1. Well, that call option won't be done until the 360, probably fourth day of the year. And then on day 365, the call option takes place, but then it still won't actually record into your account until month 13. So it's a point-to-point call option, which means every month there's a call option done. So so depending on how you've contributed, let's say you're contributing monthly, that means there's a different call option done every month. But let's say you put in a lump sum. Well, then that lump sum goes in all in January 1. Then there's a dollar cost averaging throughout the year based off that one-time lump sum. So the short answer to that question is it depends, because the call option is done every day throughout the year. So depending on when you contribute, your call option is done on a different day than mine is because of when I contributed. So I don't know if that helps or anything, but it really just ultimately depends.
Okay. And now we have this. And now this. I wish we could just play this song. Cut to the song. We need a whole, and believe me when I tell you, I have a whole playlist of punny songs that I've been trying to work in here, but we'll have to deal with some copyright stuff and just take a hit on maybe one whole stream. That way we're not messing them all up. Okay, he says, that answers my question. Thank you. Peaky's a comedian, man. Living on the ledger. Okay, so I think we're good with questions now. I'm exhausted and tired and hungry, and we've got to pack because we're going to go help in Indiana get self-directed this weekend. So we've got room of, I don't know, a couple hundred people, whatever it is. And they'll be learning how to leverage their retirement dollars to be able to invest in what they want when they want, essentially. And we'll be there to help them do that. So that's exciting. We've got to get rested up for that. What I hope that we've learned out of this particular topic in terms of reverse velocity banking, that it's not this or that. If you're looking at different videos and you're trying to understand and educate yourself on how these strategies, or which one is for you, that's typically what it is, that they're trying to decide on which one they're going to go with. It's not which one. It's not this or that. It is a machine. There are many cogs in a machine, and there's not a decision on which one am I going to go with. It is understanding how they work. Then you'll be able to make that decision. You'll feel confident about making that decision because you'll understand why that piece fits your piece. That's it. It's figuring out how your puzzle goes together. That's the name of the game. And understanding what pieces to be looking for, because now you can identify how and why it fits into your equation. These are cogs that feed each other so that you are not having to be in the position to feed them manually, right? And that's what we're doing right now. The majority of us have been in positions where we have to feed our machines manually. We have to get out and pump the gas, right? We were going to use this analogy. I was putting it together, okay? I was trying to sell Donnell on it. The concept was this. If you have a hybrid vehicle, we have one in our family, has a hybrid, and you don't charge the battery. It gets charged automatically based off of how things function, right? So this battery can last 100 to 200,000 miles, just depending on how, the usage of the car. You still have to put the gas in the car, but every tank of gas that you put in the car, you're getting how much more mileage out of it than a typical car, right? Just simply because it's essentially fueling itself, right? It's charging and fueling itself. I want you to think about that. Where in your machine are you putting in the gas and you have some sort of container, some sort of device, a repository of sorts? You like how I did
You're
that?
waiting years to use that word.
Man, he would use that word and it would drive me crazy. I'm like, don't say nobody's even using that word. Nobody knows what you're talking about. Look, today's my day. A repository of sorts. And this concept is that you get to be on the road for far longer before you have to get out and manually put the gas in, right? Now, ultimately, what would this mean? Can you gas up anywhere else? No, hybrid, you can't. But the electric cars, a solar car would obviously not require you to manually do something, right? Correct. And that's where we're going with tons of our systems, and our world is moving in that direction, and we're smart to do that. We all love the convenience of it. So why aren't we doing that within our own lives? Because we're not going to be able to afford that lifestyle if we don't, right? That part just makes sense. We do have more questions. My bad. Would day one monthly be better than any other day of the month?
I don't know that it matters, because on average, when you look at the full year in totality, I don't know that it matters what day, because it all averages itself out. So I don't know that a particular day of the month, this goes back to trying to time the market. In truth, you can't. And so if you allow the law of averages to take place, it's just a matter of paying yourself first, starting today, somewhere secure, get your money compounding, and then you leverage dollar amounts from somewhere else, someone else, OPM, to be able to grow additional dollar amounts so that you have more working for you. So if you just focus on making sure the variables in the equation are functioning properly and working effectively, it doesn't matter the day, because the law of averages will work itself out.
Yeah, it is regenerative braking. That is what I'm talking about. But what if it's regenerative banking? You say the word, and we'll cut me out of that part. Put him in.
Regenerative baking. I like it.
No, we're not taking it.
We're not.
We're not. Say it one more time, because you say it weird too.
How are you supposed to say it? Regenerative.
Oh,
banking.
okay.
Jimmy.
That sounded good. Yeah. Cut him in saying it and then cut to me saying banking. Yep. Okay.
Repository.
Repository. Repository. Okay. Oh, thank you so much, Veronica. And thank you for all the love of sending us on the road with all this love. We love it. And Piggy says, may the math be with you. Okay, Tom has a question. He says, would you start a cheaper funded SKIA for a teen child or start a personal one for me, head of the household with less compounding, limited funds to dispose here?
Depends on the goal. Because if the objective is income, there are limitations as it relates to minor children as to what it is you can contribute. So I would do the math on, if the goal is income, I would do the math on, hey, does it mathematically make more sense to start a policy on the minor, or would it make more sense to get my policy functioning more effectively and do it across the same period of time? Which one generates more income? Again, if the goal is income. But if the goal is something different, like legacy, or like, you know what, I'm okay. I've got what I need. I want to put him in a position to where he's got this vehicle to where at some point in his life he can fire his job, retire early, all of those kind of things. So it just kind of depends on what the goal is as to which one would make the most sense.
And
But I
again,
tend to let the math dictate. Go ahead.
it's not this or that.
Right.
It could be this and that. So if you start on you to make sure that everything's taken care of, knowing that if something were to happen to you, they would not be okay, right, income wise, and they would need to be taken care of. That's why it's like the oxygen mask, put it on yourself, right? If then you can leverage it, just like we were showing for this reverse velocity banking scenario, for them to start their machine with your machine, right? And
again,
allow it to feed it.
You're spot
for you.
on. Restating what you just said, it is, as cash value grows inside your own policy, use the cash value in your policy to start a policy on your minors.
Yep. You guys got this. Look at this. This is amazing. And I love to see this happen, by the way. If you feel like, if somebody asks a question and you feel like you have the answer, the best case is you get proven that you were right, right? And
Right.
We still ask Donnell and we hear that he said the same thing that you said. That's amazing. Worst thing, or the other best thing that could happen, honestly, there's no the losses here, is that you learn where you were wrong, right? Or incorrect, really.
You know who it hurts though? It hurts those who are out here pushing false products. Because what I love about this is when those individuals who are just selling life insurance thinking you don't know or you don't have the knowledge or the foundation under you to be able to stand on what is actually happening inside your product, it blows all of them away because they can't understand where it's coming from. So that's what I love about this community, is it's pulling that curtain back, showing you the mechanics and how things function. So that way you can have conversations with these life insurance providers. You can have conversations with these financial advisors, and you can break down why what they're telling you is false so that you can actually get to the truth. So love it.
That's right. And we hear this because some people end up going back to someone that they spoke with before they even learned about us. And now they went back with a bunch of questions. And they're like, hey, where'd you learn all this stuff? We don't need to talk about that. It's Stidhams. That's why I follow him. Yeah. Oh my gosh, that's hilarious. Okay. All right. Well, you guys, I hope that you have gotten a lot of value out of this. We would love your feedback on what you think about this concept and how we've explained this concept. 1 to 10, do you feel confident about this topic or this strategy? Do you think that you could maybe even like explain it to somebody else? That's maybe a good way of making sure that you do understand it. Then come back and let us know, or jump in the Facebook group so that we can better understand how to serve and how we can help more people get started taking action sooner. So that's really the goal for us. We just want to make sure that we're putting it in a way that makes sense. Make it make sense. You know what I mean? Okay. So on that note, we like to end with, if you didn't come from a wealthy family,
You can make sure a wealthy family comes from you.
So stay tuned,
Stay protected.
stay focused.
Stay connected.
I'm Angelique,
And I'm Donnell.
and our goal is to help you
Get self-directed.
And to do that, we have a ton of free resources and a growing community. So get in here, jump in here and take advantage of them. And in the meantime, we're going to go help more people, and we will see you back here on Sunday. Thanks for watching, guys. Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get
Get self-directed.